In this video, we're going to start some discussion about how we evaluate stocks. So we'll first talk about some characteristics of stocks, and then we'll discuss some of the different valuation techniques that can be used to determine what an investor might think the stock is worth. So first, some basic facts. We know that stocks represent ownership. Ownership implies control. The stockholders elect the directors. Directors elect the management. And again, as we've mentioned in some previous videos, management's primary goal is to maximize the stock price. Now, what are the differences between debt and equity? Well, the first big thing really is the voice in management, right? The owners of a company make the decisions. The creditors provide funding when asked for, but they have actually no control over what goes on inside the company itself. As far as claims, the owners of the company have claims to everything, right? They own the assets, right? So they have the claim to income and assets. Now, they don't always stand at the front of the line when things are distributed. In the case of bankruptcy and liquidation, the owners sit at the end of the line. As far as maturity, we assume that equity has an infinite life, right? It's going to last for a very long time. Debt, on the other hand, has a fixed, finite maturity time. And taxes are certainly different. Now, the taxes, when we talk about taxes here, we're talking about taxes from two perspectives. The taxes that are used as expenses by the company. Interest is tax deductible, but the dividends that are paid to shareholders are not tax deductible. And the taxes that are paid by investors are also different. If you receive interest income, you pay tax at your marginal tax rate, which for an individual could be as much as, I think it's as much as 35%. But if you receive dividends, the maximum tax on dividends now is 20%. So the taxation is different depending on whether you're the company or an investor, but also between debt and equity. So let's move on. And as I just went through this example, right? So the differences between debt and equity, interest payments to debt holders are their tax deductible expenses by the company, and the dividend payments are not tax deductible to the firm when they pay. Now this makes a difference, right? I mean, if you're a company, a manager, and you want to distribute something to the owners, would you rather distribute interest or dividends? Well, you want the one that ultimately is going to have the greatest benefit to you. And of course, you would like to be able to take a tax deduction. We've mentioned this several times, the differences between intrinsic value and stock price, right? So investors in general, whether they're outside investors, corporate insiders, some kind of a financial analyst, we're going to use a variety of methods to try to determine the company's intrinsic value. And in the end, right, we want to decide what we're going to do. Do we feel that the company's value is over or under what the current stock price is? So again, we want to talk about this process, right? There are different techniques. Each technique has some different ideas and different processes different data that it uses to come up with this valuation. So we're going to discuss three basic valuation techniques in the next several videos. The first one we're going to talk about is the discounted dividend model. Any company that pays dividends, you should be able to use this discounted dividend model to calculate its value. The corporate valuation model uses a different set of data. Instead of dividends, it's going to use free cash flow. And we're going to try to determine the overall value of the entire company, not the stock. So the dividend model will calculate a value per share. The corporate valuation model calculates the value of the corporation. And we also have a set of techniques that are referred to as market multiplier models. So these are just techniques that utilize some relationships between price and a variable within inside the company. If you can predict the variable, it implies you can then predict the value of the stock itself. So let's get started with the constant growth model. This is that dividend valuation model we were talking about. So the basic formula for any asset is that the value is the present value of all future dividends. If you remember, one of the things we said a little earlier was that we assume the company has an infinite life. If that is true, we need to find the dividends from here to infinity. So how do we do that? Obviously, it's not possible to calculate something to infinity, but this formula, if we assume two things, if we assume constant growth in dividends, and if we assume this infinite life, then this formula simplifies to this formula. So one of the things I want to make sure we understand is that this formula does not look like a time value calculation, but this formula does, right? 1 divided by 1 plus RS to a certain power, that is a present value interest factor. So it is in this model, but it doesn't appear here. But algebraically, with those two assumptions, these two models are the same. They're equivalent algebraically. So how do you find the value of a stock? You need to know today's dividend, D0, the most recent dividend paid. You need to know R sub S. We've talked about R sub S in other videos when we were talking about the required rate of return for a stock. So we know the required return on stocks. We can calculate that. Certainly we know D0 because we were just paid that. The thing that we have to focus on, the uncertainty here, comes from the variable G. And G represents the future growth rate of dividends. So let's see how we can use this formula. So our first example talks about a stock, but this stock is a special kind of stock. It could be a preferred stock. It could be a stock where the company pays a constant dividend. There are lots of companies that do this. They basically pay, let's say, a nickel every quarter, and they do that forever and they never change. So that is what we refer to as an infinite growth stock, but the growth is 0%. So in our spreadsheet that we have for finding value, we can put our information in our corner here. We need 15% is the growth rate, 0% is, 15% is the required return, 0% is the growth rate. And down here, under D0, we place the most recent dividend. Remember, D subscript 0 means today. 0 is today. So that's today's dividends, $3. So in this case, this stock would be worth $20. So would you buy this stock? Well, we need some more information, right? So the current stock price is selling for $19. Would you spend $19 to get something that was worth $20? And of course you would. Now, if you paid $19 for this, what would you expect to earn on this stock? Well, the expected return is calculated right here, 15.78%, right? Or 15.79%. Compare that to the 15% required return. If all you wanted was 15 and it was going to pay you 15.7, of course, you would want to buy the stock. So let's think about another definition or another version of this. In this case, the most recent dividend was $2.65. The stock dividends have historically grown at 5%. Has a required return of 10% or 20%, and the stock is currently selling for $15. How would you calculate this value using the constant dividend model? Of course, you can plug it into the formula right here, or you use the spreadsheet. If you plug it in the spreadsheet, what we'll find, a stock has a value of 18.55. Stock price is 15. Again, would you pay $15 to get $18.50? Of course you would. If you bought it for 15, you'd earn approximately 23.5%, and you only wanted 20%. So again, this is an example of a good investment for a stock. So let's see how we can look at some of these variables for a little closer. How can you find the growth rate, the future growth rate of dividends? Well, the one thing we know is we know what the past is. So if you look at the past, at least we know what the historical growth rate was. And in our example here, the stock paid $1 in 2010, paid $1.40 in 2015. In our worksheet, we can plug these in. D0 obviously is the most recent dividend. The first dividend is the one farthest away. N equals 5. So this growth rate is roughly 6.96%, or on average, you could say it's a 7% growth rate. How can you find the required return? Well, we can utilize the security market line formula from the risk analysis that we've done. In this case, we were told that the 30-year Treasury bond is selling at 4.75%. The average rate of return of the stock market is 12. And this stock has a beta of 1.45. So the required return is 15.26%. So let's plug this into some information to figure out the value of this Lamar Company stock. Here we have our dividends. Here's our 6.96%. And again, you notice the 6.9% is here. You just type that number in here for growth. The other thing that we have figured out is the required return. And you see it's 15.26. Again, you plug that number up here, and we'll find that the value of this stock, $18.04. The company is currently selling for $17.50. So again, you would pay $17 to get something worth $18. If you did that, you'd earn 15.52%, And in this example, you wanted 15.26%. So you earn a greater return than you want, and you'd be willing to pay a lower price than what the value of the asset was. So let's take these numbers a little bit closer. Let's talk about something called the dividend yield. That's the next year's dividend divided by the price. So in this case, it's $1.50 divided by the $17.50 price. That's 8.56%. The capital gains yield is the future growth rate of the dividends, 6.96%. Now, if you add those together, you get the total return of this stock. It's the dividend yield plus the capital gains. That gives us what? 8.56 plus 6.96. You end up with a total return of 15.52. And in our spreadsheet, that is indeed a calculation we have for the required return. So what happens in this scenario if the future growth rate of dividends is greater than the required return on the stock? Well, of course, in the formula, that would give us a negative stock price. And negative stock prices don't exist. So this constant growth model can only be used if the required rate of return is greater than G, if G is expected to be constant forever, right? And of course, it has to have a dividend to begin with, right? You have to have a dividend. The required return has to be greater than the growth rate of dividends. And again, our assumption is that these dividends grow at a constant rate forever. Now, we know that dividends don't grow at a constant growth rate forever. It is an assumption we make. It adds some uncertainty to our analysis. Again, that's the end of the first video on stock valuation. I look forward to talking to you soon.